Welcome back. Having been introduced to the derivative markets and the various types of derivatives, we move on to study the basics of derivative pricing and valuation. In this first part, we shall first understand the pricing principles of the underlying assets. We shall review arbitrage again, followed by the concept and application of no arbitrage derivative pricing. We end off with a brief discussion on replication. Let's get started. We've learnt earlier that derivatives are financial instruments that derive value from the performance of their underlying assets. The underlying can be financial assets like stocks and fixed income securities, physical assets like commodities, or even non-assets like interest rates. Let's first examine how underlying assets are priced. Although the specifics of pricing the various underlyings can differ, all of them are based on these four factors: expectations, risk, and the benefits and costs of holding a specific underlying. Let's examine each of these factors. We'll start with expectations. We first assume that there's no benefit or cost associated with holding a particular asset. Some financial assets, like a zero-coupon bond, do fulfill this criteria. The bond does not pay out any cash flow while holding it, and there's no cost like storage or convenience benefits associated with holding the bond. So, an investor who wishes to determine the value of such an asset in the future just needs to estimate the expected future price based on its current spot price. Obviously, as with most risky assets, there's uncertainty in the expected future price. Nonetheless, at time zero, the investor makes her best prediction of the spot price at time t. This is the foundation for the pricing relationship which we're about to cover. So for an asset that has negligible holding costs or benefits, its expected future price is simply the spot price multiplied by the discount rate compounded over t periods. Rearranging, the spot price is the expected future price discounted to its present value. The question is, what is the discount rate that should be applied? At a minimum, that rate will include the risk-free rate of interest, which we denote as RF. This rate represents the opportunity cost. It reflects the price of giving up your money today in return for receiving more money later. The harder part is to determine the risk premium. To do that, let's briefly discuss the concept of risk aversion. In finance theory, investors can either be risk-averse, risk-neutral, or risk-seeking. Explaining it simply, given that there are two assets that have the same yield, one is risk-free and the other is risky. A risk-neutral investor will be indifferent between the two. Either investment is fine to her. A risk-seeking investor, strangely, will prefer to put her money in the risky asset, even though both assets have the same expected return. A risk-averse investor, however, will prefer to put her money in the risk-free asset since there's no incentive in taking on risk. For the purpose of this exercise, we shall consider the risk-neutral and risk-seeking investors as not realistic. We shall assume that all investors are risk-averse. To convince a risk-averse investor to take risk, the risky asset should be priced at a discount relative to the risk-free asset. This means that the investor expects additional return in the form of a risk premium. If this risk premium is sufficiently large to compensate the investor for taking on the risk, she may consider this risky asset in place of the risk-free asset. It's very important to understand, however, that risk premiums are not automatically earned. They are merely expectations, so the actual outcomes may differ. Nonetheless, risk premiums must exist in the long run, or risk-averse investors would not accept the risk. So we'll assume that investors are risk-averse, meaning that this risk premium has to be positive. For an asset like a zero-coupon bond without interim costs and benefits, the current price should be the expected future price discounted by the sum of the risk-free rate and the risk premium. For assets that do come with interim benefits or costs, such factors should be considered in the valuation of the asset as well. Benefits to holding an asset can either be monetary or non-monetary. Dividend payments on a stock or interest payments on a bond are examples of monetary benefits of owning an asset. Non-monetary benefits are sometimes referred to as its convenience yield. This is only significant for some assets, primarily commodities. Convenience yield is discussed in detail in the course on alternative investments. Assuming that such potential benefits of holding on to an asset are certain, the monetary value of such benefits should be discounted back to time zero using the risk-free rate. The present value of the benefits should be added to the spot price. Costs of holding onto an asset should also affect its price, particularly for commodities. One cost that is often incurred is the cost of storage. One could hardly own gold, oil, or wheat without incurring some costs in storing these assets. There are also costs incurred in protecting and insuring some commodities against theft or destruction. Depending on the commodity, these costs can be quite significant. Likewise, the monetary value of such costs should be discounted back to time zero using the risk-free rate. The present value of the costs should be subtracted from the spot price. The net cost of holding an asset, considering both the costs and benefits of holding the asset, is known as the cost of carry. Taking into account all of these costs and benefits, we can describe the relationship between the current spot price of an asset with these four elements as such. Understanding how underlying assets are priced in the spot market is crucial to understanding how derivatives are priced. To understand derivative pricing, it's necessary to establish a linkage between the derivative market and the spot market. That linkage occurs through arbitrage. We've briefly introduced the concept of arbitrage in the previous lesson. We know that, based on the law of one price, two different securities with identical payoffs in the future should have the same price. Otherwise, an arbitrage opportunity exists. Looking deeper, can you think of any two securities that would produce identical payoffs in the future? You may be hard-pressed to think of any. In markets for traditional securities, we don't often encounter two assets that have identical future payoffs, even for very similar companies in the same industry. The picture changes, however, if we introduce derivatives. For most derivatives, the payoffs may not be identical, but they come directly from the value of the underlying at the expiration of the derivative. Although no one can predict with certainty the value of the underlying at expiration, as soon as that value is determined, the value of the derivative at expiration becomes certain. This property of derivatives allows investors to construct hedged portfolios. A hedged portfolio can be constructed by taking a position in the underlying and taking the opposite position in the derivative at the same time. This creates a portfolio with no uncertainty about its value at some future date. To understand the concept of hedged portfolios, let's go through an example. Let's say there's an asset that's traded at $100 at time zero. At this time, a forward contract that expires in exactly 1 year is priced at $103. So an example of a hedged portfolio is if an investor longs the underlying asset at $100 at time zero and simultaneously enters the short position of the forward at a contract price of $103. Since there is no cash flow involved at the initiation of the forward, the net cash outflow from the investor at time zero is $100. At expiration, the investor is obligated to sell the asset at $103 to close the short position. The investor simply delivers the asset which he owns and collects $103 regardless of the market price of the asset at expiration. The investor earns $3 in a year, or a 3% return, without taking any risk of the underlying asset other than the counterparty risk. The investor will get a 3% return regardless of the price of the underlying at expiration. Now, let's bring back the asset pricing equation that we've learnt earlier. Let's assume that holding the asset Y has negligible costs and benefits. The expected future price is therefore the spot price, compounded by risk-free rate plus risk premium. Let's assume also that the risk-free rate at time zero is 3%. If that's true, This means that the risk premium in this case is zero. Now, we know that for a risk-averse investor, zero risk premium would not hold. So, is there a pricing error of the forward at time zero? Let's say the forward is priced with a 2% risk premium at $105 instead. If that's the case, an arbitrageur can sense the opportunity and borrow $100 at the risk-free rate of 3% to buy the asset. He will simultaneously enter a short position at the contract price of $105. At time zero, the net cash flow from the arbitrageur is exactly zero. At expiration, the arbitrageur simply sells the asset for $105 to fulfill the contract, and uses $103 from the proceeds to repay the loan. As you can see, the arbitrageur earns $2 without putting in any cash. Now, we know that such arbitrage opportunities cannot last for long, for when many arbitrageurs realize the opportunity, the buying pressure on asset Y will push its price up, and the increase in shorts will push the forward price down. This continues until the forward price returns of this portfolio are equal to the risk-free rate of 3%, where no arbitrage is possible and the risk premium is zero. The important point to understand from this illustration is that while the risk aversion of investors is relevant to pricing assets, it's not relevant to pricing derivatives. As such, derivatives pricing is sometimes called risk-neutral pricing. So, based on the principles of arbitrage and risk-neutral pricing, only one price can exist for the derivative. We call this the no-arbitrage derivative price. The no-arbitrage derivative price has to satisfy this equation: the purchase of the underlying asset at time zero plus the short position and the forward at time zero equal to the present value of the net payoff at time t, discounted by the risk-free rate. This equation can be generalized to a position in the underlying asset plus the opposite position in the derivative is equal to the present value of the net payoff at time t, discounted by the risk-free rate. Now, going back to our example, do you realize that the cash flows and risk characteristics of this portfolio is exactly the same as a risk-free bond? In both instances, the investor places $100 at time zero and gets a return of the 3% risk-free rate after 1 year. In other words, an asset and a derivative on the asset can be combined to produce a position equivalent to a risk-free asset. It follows that the asset and the risk-free asset can be combined to produce the derivative. Alternatively, the derivative and the risk-free asset can be combined to produce the asset. This process of creating an asset or portfolio from another asset, portfolio, and/or derivative is known as replication. So for this example, we show how a long forward position in an asset can be replicated by borrowing at the risk-free rate to buy the asset. In taking a long forward position, an investor agrees to sell Y 1 year later. At the initiation of the contract, the investor does not fork out any cash, so his net cash flow is zero. On the other hand, the investor can replicate the long forward position by borrowing $100 at the risk-free rate and using the money to purchase the asset. Similarly, his net cash flow at time zero is zero. At expiration, the market price of the asset is now S1. Under the forward contract, the investor has to buy the asset at $103. He can then sell the asset on the market for S1. So his net cash flow at expiration is S1 minus $103. Under the replicated portfolio, the investor sells the asset at the market price of S1. The investor also has to repay the loan by returning $103. So likewise, his net cash flow at expiration is S1 minus $103. As you can see, the net cash flows for both portfolios are identical. This illustrates how a long forward can be replicated by buying an asset and borrowing at the risk-free rate. And that concludes this lesson, where we've learnt some of the fundamental concepts of derivative pricing. We shall apply these concepts in the following lessons in the pricing of forwards, swaps and options. See you at the next lesson.